to adjust everything. So 23, you see, 21, 22, 23 now, 24 with for our double view.
Yeah, I don't know how many people we will see the YouTube channel in streaming.
24.
We are not so much.
Ah, yes, but it is increasing just now the number, 24.
Okay, good.
You see, if you wait 1 more minute, maybe you can start the presentation.
Yeah, that's what I was planning to do.
Yes.
So we are now live.
No,
so
because the YouTube streaming also make the registration. So this is why.
Yes, I know.
Okay, so we can start.
But I've done. I'm just
okay.
Changing the title of the video, so it's done.
Okay.
And go.
So let's start. Okay, so welcome to everyone to this fourth and last event in the series of SICC talks. Today we will have the pleasure to listen from Davide Radi and Noemi Schmitt. They will be presented by Fabio D'Ercole, that will be the chair for this section. So I give him the floor and stop talking.
Okay, very fast, Mattia. Very good.
Yeah, I promise it.
Okay, so good afternoon, everyone, by my side as well. I'm also a member of the SICC board, and I have the pleasure today to introduce our speakers. As Mattia said, Davide Radi first and then Noemi Schmitt. Davide is associate professor at the Department of Economics and Management of the University of Pisa in Italy, and he's also research fellow at the Department of Finance of the Technical University of Ostrava in Czech Republic. Yeah, can you hear me? Yeah. Yes, I hear some noise, but go ahead. While Noemi is currently a research fellow at the Department of Economics of the University of Bamberg in Germany. So Davide and Noemi, as far as I know, they have rather similar research interests, which essentially are focused on the nonlinear origin, I would say, of relevant economic dynamics. And I have used 3 keywords that are nonlinear, the first, underlining the complexity of economic markets nowadays. The second is dynamics, meaning that Noemi and Davide, they don't just look at market equilibria, which are sometimes rather theoretical, but they study the economic change over multiple time scales. And the third keyword is relevant, because they apply their models to important problems in finance. They're not just speculative, but they are really applied to important problems such as market volatility, instability, bounded rationality, adaptive trading strategies, and risk. So today we like to exploit the synergies of Davide's and Noemi's expertises in a pair of twin talks, which has the same title. The title is Explaining the Dynamics of Financial Markets via Nonlinear Dynamical Systems. So we start with Davide first. So thank you, Davide, for your time, and the virtual floor is yours.
Thank you very much. Thank you, Fabio. I'd like to thank also the SICC, the Italian Society for Chaos and Complexity, for this invitation. Also Laura Gardini, that also I think asked me together with Fabio to give this talk. And it's a pleasure for me to do it. I do this talk together with Noemi, so I will first, we present substantially 2 different models, 2 different applications. I can imagine that the audience is not an audience specialized in finance. That's why in my first part of the talk, I will just provide an overview of the possible models and an explanation why this type of models are important in finance. And then I will switch to a specific application, and later, I guess, Noemi, she will present us a second application. So first of all, why it's important nonlinear dynamics in finance? Because what we want to do is we want to somehow replicate some elements of finance, in particular the prices of some real financial assets, as it could be indices, like these are three figures that I presented. There are three different indexes in finance. The first one, for example, is what is called CAC 40, which is an index that put together is an average of prices of assets in the financial markets in France. And you can see, if you look at this price, we can see that there are sort of irregular dynamics or cyclical dynamics, but they are not linear. And for sure, this dynamics doesn't show any equilibrium dynamics. And also, if you look, for example, also not only to this index, but to other three indices that I present here, we observe in a similar way sort of cyclical irregular dynamics. So when we look at these graphs, we can say that financial markets are usually complex, and we may also say chaotic. And if we represent financial markets, how do we represent this chaoticity in the financial market? Usually, we do it, imagine that these financial markets are populated by sort of irrational agents, okay? Where irrational means that they have some sort of rules that they apply in order to decide when to buy an asset or when to sell it. So the models that we present today in these talks are models that are represented by nonlinear maps, usually dynamical system in discrete times, and represent the fact that financial markets are usually represented as a pool of traders with different type of trading rules, different type of expectations, and putting together these traders in a unique market generates irregular dynamics, the irregular or cyclical or chaotic dynamics. Just to put a bit of order in the type of models that try to represent, to replicate the price in the financial markets, okay, I would like to organize, although there is not a real distinction between these two types of models, I would like to distinguish models that are called models of bounded rational agents with heterogeneous expectation and adaptive dynamics. This type of model are models in which agents have different expectation, and moreover, we introduce adaptive dynamics. That means that there is mechanism that select which is the best expectations. So in some sense, there is a sort of selection of which is the best expectation, the best trading rules. And this type of model are inspired by the seminal contribution by Brock-Holmes 1998. And mathematically speaking, these are usually smooth dynamical system of high dimension, where by high dimension, I mean 3-4 time dynamical, 3-4 dimensional dynamical systems. Instead, we have another type of models that they are a bit more stylized than the other one, in which basically we assume that the financial market is populated by agents with very simple but heterogeneous trading rules. And this type of models are usually non-smooth systems, but have a lower dimensionality, usually are one-dimensional or two-dimensional dynamical systems. And these type of models are inspired by the original contribution of Day and Wang in 1990. Let me just give you a bit an idea on how these two different types of models are made. So roughly speaking, the first group of models that we consider are have a, let's say, a functional form in the, that is represented by this equation 1. In particular, in a nutshell, this model tries to predict the price that we observe in a financial market tomorrow, and look at this price as simple convex combination between two different functions of past prices, where these two functions, F1 and F2, for example, called here, are function of past prices. And this F1, F2 represent the expectation that different agents have about the price that could be tomorrow. And I said, we take a convex combination because actually this function f1 and f2, these two different expectations, are multiplied by a parameter eta, where eta indeed is a function of time and itself is a function of past profits that indicate which one of these predicting rules, f1 or f2, perform better in the past and what is the probability to adopt this rule in the future. So we have different rules, different expectation, f1 and f2, and we have also a mechanism to select which one of these rules is the better. And so which one has more probability to be used in the future. This is a bit the baseline structure of this type of model. The function f1 and f2 are usually smooth functions, as well as g is a smooth function. And this type of model, therefore, are nonlinear, smooth dynamical system. This type of model presents a sort of a dynamics that is characterized by an equilibrium that often loses stability because this function f1, f2, and g depends on some parameters. And so the equilibrium of this model usually loses stability. And when it loses stability, the loss of stability occurs through the classical period doubling bifurcation. And if we move the parameters in a particular way, we can also obtain chaotic dynamics. And usually this occurs through the classical period doubling cascades bifurcation, where at a certain point we observe chaotic dynamics. In this type of model, we can introduce also some form of discontinuity, usually by trying to replicate specific regulations. For example, in a market, when the price tends to rise too much, there could be an authority that imposed to stop buying the assets. So in particular, F1, F2 can have some constraints imposed by the regulation. We can imagine something like that. And so we can have a model that is nonlinear with some point of discontinuities. Example application of this type are, for example, the paper by Anufried and Tuinstra published in 2013 in JDC, and also I have a contribution with Fabio that we published last year, where we have a model like this one, where we impose a constraints, and we impose these constraints because we try to replicate a specific regulation, and we have a nonlinear system which is not smooth.
Actually, Davide, if I can interrupt, you said just now that our model is non-smooth. So this class of model is not necessarily smooth. It depends on how the two agents, on how the expectations of the two agents are formulated. They can be as well formulated in a non-smooth way. I mean, it depends on the modeling choices.
Yes. Let's say that if we don't usually impose regulation restriction, they are smooth, but we can also say, okay, we want to try to regulate some try to replicate some policy, and we make these models non-smooth because we want to
even the extension about risk evaluation that we discussed recently, it's non-smooth, not because of a regulation, but because of the modeling assumption on how you evaluate risk.
You're right. Yeah, okay. Let's say we can also complicate it to introduce non-smooth dynamics. Yes, that's true. But if we look,
the distinction between the two classes of models you are proposing, the main distinction is probably not the fact that one is smooth and the other is not.
There are some microphone open, I guess.
Maybe Ricardo, you have your microphone open, I guess. Maybe we can switch them off.
I put the microphone off of one of the participants.
Okay, please go ahead. Sorry.
Okay. And so we have this type of models that, as Fabio said, we can always complicate it and make it also this model non-smooth, but traditionally they are presented as nonlinear, smooth dynamical system, where the type of bifurcation that we have are the classical cascade of period doubling bifurcation till we observe some chaotic dynamics. Interesting, if you like this type of model, if you want to read some papers about it, I can suggest a paper published in 2008 in a Journal of Economic Behavior Organization by Gaundersdorfer, Holmes, and Wagner, where they analyze a particular type of bifurcation that can occur in this system, which is a degenerate sense-linear bifurcation. And this one is important because it leads to a configuration in which we have an equilibrium which is stable, surrounded by another equilibrium, by a limit cycle which is unstable, and outside we have another limit cycle which instead is stable. So we have two attractors, an equilibrium and a limit cycle, and according to which to where you start, you can converge either to an equilibrium or to a limit cycle. But it's interesting, this configuration, because, for example, if we buffer this system with some form of noise, we can easily switch from the basin of attraction, for example, of the equilibrium, to the basin of attraction of the limit cycle. So we change the configuration of the, we switch from one basin of attraction to the other. So the dynamics or the overall dynamics of our system change configuration. From cyclical and dynamic, we switch to an equilibrium, and then we can switch back because we are buffered by noise to a limit cycle. And this type of dynamics is important because it's a possible explanation why in the financial market we observe a phenomenon known as volatility clustering. So in particular, which means that we have period in which, if we look at the return, the logarithmic return, so the logarithmic of the price tomorrow divided by the price today, we look at the dynamics of this return, we observe period in which these returns are really small, okay, and period in which these returns instead are very volatile. And this can be explained with the fact that we can often switch from the basin of attraction of a stable equilibrium to a limit cycle. Then we move to the other class of model. Although, as I said before, as also Fabio underlined, let's say the confine between these two models is not so clear. I mean, they are both models with heterogeneous type of traders. But this second group of models are somehow more stylized and try to simplify a bit the behavior of agents, and they represent the price of the market tomorrow simply as the price of the market today plus an adjustment coefficient A, which is positive, multiplied by the sum of the demands of the heterogeneous traders present in the market, where usually this function D1, D2, D3 represent different type of trader present in the market, and this type of function are usually not smooth or even not continuous, because they represent very simple trading rules, like, for example, buy when the price increases, sell when the price decreases, try to catch a sort of a trend, and so on and so forth. And these type of models are usually one-dimensional, especially the first version of these models studied in the last decade are usually one-dimensional, so it means they are very simple. And the type of complicated dynamics that this type of model can generate are just due to the fact that this function D1, D2, D3 are not usually smooth, are discontinuous functions.
And Davide, if I can again interrupt.
Sure.
So if I understand correctly, there is no adaptation of the agent. So there is the underlying assumption that the population is divided into three, for example, different type of traders, and they don't change strategy during time.
Absolutely, that's correct. So we suppose that there are traders, they never update their trading strategy, and these trading strategies are very stylized, represented by non-smooth functions, substantially. Of course, we can always introduce an adaptive mechanism also in this type of model, so we can also make this type of models non-linear because of this adaptive mechanism. Okay, they are already non-linear because they have point of the discontinuities, but we can increase the non-linearity by introducing an adaptive mechanism that select which one is the best trading strategy in these models, But the point, the good things of this model is that they are very simple, and although they are very simple, they can generate complicated dynamics that are necessary to describe some of the stylized facts that we observe in the financial markets. So the philosophy of these models usually is that take the simplest version possible that can replicate as many stylized facts possible. So this is a bit the philosophy. So as Fabio said, we can always make it more complicated, but as soon as we have something that works, we are fine with that. We like it. And this type of model were studied quite a lot in the last decade. Here there is a long list of papers studying this type of models. Probably the researchers, the scholars that study the most this type of models are for sure Fabio Tramontana, Laura Gardini, Frank Westerhoff, Noemi as well studied a lot this type of models. And you can see there's a long list of publications. And also, if you want to have the slides to have a look at literature related to this type of model, you can have a look at these slides and find the interesting papers. Also here, of course, these are, as I said, these are piecewise linear models. And if you are interested in bifurcation or type of dynamics that can be generated in this type of model, I can suggest two books, two very important books, one by Di Bernardo and others, and the other by Irina Sushko, Laura Gardini, Fabio Tramontana, Victor Avertin, where you can find a description of the majority of bifurcation that you can have in these one-dimensional piecewise linear maps. These are good books to look at the mathematics that you can find behind these financial markets models. In the last years, this type of models, the one-dimensional models, have been extended by introducing some further element of complexity. For example, introducing some type of trader that look at the trends in the financial markets, which means if I observe that the price tends to increase over time, I'm used to buy more of that asset because I expect that the price will increase also in the future. Of course, if I look at the trend, I cannot observe only the last price available, but I need to observe also the previous prices. Therefore, from a one-dimensional dynamical system, usually I go to a two-dimensional dynamical system. Also three-dimensional dynamical system if you want to have a look at even more historical prices, but let's say that already with a two-dimensional dynamical system, we can have a model in which we have traders that trade according to the trend that they observe in the market. And this type of models, so usually they are two-dimensional piecewise linear models, and they have the configuration shown here in this slide. So the price tomorrow that we observe in the market is given by the price today plus a coefficient that multiplies the excessive demand of the traders. And this demand doesn't depend anymore only on the price in the previous periods, but also on the price on the previous period. There are different reasons why we should consider prices not only today, but also previous prices when we decide our demand of assets for tomorrow. It could be because we are trend followers, so we try to follow the trend, because we want to imitate someone else, or for other type of reason, like, for example, because we look at the so-called sentimental traders. And here I present different type of papers that consider this type of models. Mathematically speaking, this type of models are interesting because, of course, the dynamics that we can have in a two-dimensional piecewise linear model is different from the dynamics that we can have in one-dimensional model, one-dimensional piecewise linear model. And studying these differences, it's important also from a financial market point of view, because we will see now in the application that I will show you, there are some differences in the dynamics that are important, for example, to explain some phenomena in the financial market. Another point, information that I want to provide you about these models are the type of applications. In particular, these are all financial nonlinear models that try to replicate prices in the financial markets, but the financial markets are many. We can have stock markets, for example, that we want to replicate the price of the share issued by a specific company, like could be Apple, Tesla, Microsoft, and so on and so forth. But another aim could be to replicate other financial elements, such as the exchange rate, or we want to replicate, for example, the price of houses. So we have the housing market. So here we have three different, for example, applications, three different financial markets on which for which our models can be used to replicate the prices. And in particular, Noemi will present a work in which she tries to describe and to replicate the dynamic in a stock market, while I'm presenting now a paper that is a joint work with Noemi, where we try to apply this model instead to replicate an exchange rate, the price of an exchange rate market. So what I'm going to do now is just to present this application, and it's a paper that we finished a few months ago, as in collaboration with Laura Gardini, Noemi Schmitt, Elina Schlusko, and Frank Westro. What do we do in this type of paper? First of all, this is a paper in which we have a model which is a piecewise linear, two-dimensional model. And what we try to do is try to describe the effect in the exchange rate of two policy interventions. One is currency manipulation and the other is currency war. In particular, currency manipulation occurs when one central bank tries to intervene in the market to undervalue its own currency, because if a central bank undervalues its own currency, then basically what is the effect is to boost its own domestic economy. What is a currency war? A currency war is a consequence of a currency manipulation, because when one central bank tries to devaluate its own currency to take advantage of another economy, the central bank of the other economy or of the other country can also decide to intervene in the market and to do the same. If two central banks try to do currency manipulation one against each other, we have a currency war. And we try to represent this through a two-dimensional dynamical system. We do that assuming that in the market there are not only the central banks, but there are several types of agents. In particular, we can have traders, speculators, non-speculators, plus the central banks. In particular, we have four types of traders. We have international operating firms. Basically, the idea is very simple of this model. We define a variable, PT, which we call the exchange rate, which is exactly the price of buying country's B currency. So here we have a situation in which we have two currencies. Think about euro and US dollars, okay? And you need to have US dollars, for example, to buy euros, or the other way around, you need some euros to buy some US dollars, okay? Imagine that PT is the price of euros that you need to buy US dollars. So countries B currency, imagine to be the US dollars. And we can also imagine that we have a fundamental value. So a fundamental value is a sort of an external value of this exchange rate, which is, for some reason, some economic reason, is the value of equilibrium. Okay, we don't care why it's the equilibrium. Okay, it's exogenous given, and that is the equilibrium. And then we have agents that do the following. We have different type of agents. The first type is international operating firms that say the following: look, we have this equilibrium value F of the exchange rate. We observe the real exchange rate, and we say, look, if the exchange rate, the real one, is below the equilibrium value, then it means that the currency is undervalued. So what we do, we buy the currency because we know that it's undervalued. So it should increase value in the future, because if it's undervalued, it means sooner or later will converge back to the equilibrium. And so we have a positive demand of the currency when the price is below its fundamental value. A similar type of activity is made by the fundamentalist. Already the name of this type of traders suggests that these traders believe that the price sooner or later will go back to the equilibrium price, which is the fundamental value. And so they buy the currency when the price is undervalued and they sell it when the price is overvalued. Moreover, we have other type of traders like chartists that do the opposite. So basically, they believe that the market can stay overvalued or undervalued for a long period. So as long as they observe that the market is overvalued, they keep demanding more of the currency. And when they observe that the market is undervalued, they keep selling the currency. And their demand, so it's just represented in this way, is C parameter positive as F and I, and C is multiplied by PT minus F. Moreover, we have a fourth type of trader. This is the extrapolators, that instead they believe in the trend. So if they observe that the price is increasing, they will have a positive demand of the currency. So because they realize that the price of the currency is increasing, and so they expect that also tomorrow will increase the price. And so they demand currency. They don't care at all about the equilibrium value, about F. As you can see, if you look only to the demand of international operating firm, fundamentalists of chartists, then we have that their demand depends only on the price in the previous period, while if you look to the demand of extrapolators, their demands depend both on the price in the previous period, but also on the price in the previous period. So we have PT minus 1. And so the fact that we have a two-dimensional dynamical system depends on this type of trader, the extrapolators. Without these traders, we would have a model which is one-dimensional, piecewise linear. If we observe these demands, by the way, okay, we see that these demands are not actually discontinuous functions. Okay, they are just smooth functions. Indeed, the non-smoothness in the system is introduced not by the traders, the speculators, but by the central banks, because the central banks have special rules, in the sense that if I'm country A central bank, of course, the country A central banks does not have any reason to intervene in the market, okay, as long as its currency is undervalued. So if I'm country A central bank, as long as the currency of country B is overvalued, so it means the currency of country A is undervalued, okay, this type of bank just don't do anything, basically, okay? It's just happy because of that. Its own currency is undervalued, is happy, and it does not do anything. But as soon as its own currency becomes overvalued, so it means PT, the currency of country B, becomes undervalued, this bank tried to intervene in the market, okay, in order to sell its own currency and try to decrease the overvaluedness of its own currency. And so one central bank intervenes only if the price is above or below the fundamental value. It depends which bank it is. And how does it intervene? Intervenes in two ways. Intervenes, let's say, selling a fixed amount independently on how much the price is overvalued of its own currency. So you see we have this plus A0, which is a parameter, which is fixed, is positive. Plus, it intervenes in the market by selling a certain amount of its own currency, which instead, this amount depends on how much its own currency is overvalued. Because you see, we have A1 multiplied by this quantity here. So we have a component that is called autonomous demand component, which doesn't depend on how much my own currency is overvalued, and another component instead that depends on this coefficient A1, which instead is called the price sensitivity demand component, because this component depends on how much my currency is overvalued. The same type of action can be taken by countries B, central bank, but of course, the price of the currency of the central bank B is denoted by PT, and when it's overvalued, so when PT is greater than its equilibrium value, the central bank intervenes in the market and decides to sell its own currency with the aim to start to make it a bit less overvalued, okay? And intervenes in the market as long as his currency is, the price of his currency is above the equilibrium value F. This type of mechanism, this type of interventions by the central banks introduce, of course, discontinuity in the system. Then we put all these demands together, so the action of the traders, fundamentalists, chart and extrapolators, so these demands, the I, the F, the C, the E, and the demands of the central bank, the A and the B, we sum up them all together, okay? And we multiply by a coefficient. This coefficient is a coefficient that says how fast the market reacts to the demands of trader or to the demand of the central banks. And the price tomorrow, PT plus 1, the price of the currency of country B tomorrow, is just equal to the price of the currency today plus this coefficient M, which is positive, multiplied by the sum of the demands of traders. Of course, these demands can be positive if they demand currency B, can be negative if they sell currency B, and their sum can be therefore positive or negative. So what we have inside here, this common brackets, can be a positive or negative quantity. So the price tomorrow can either increase or decrease according to what the traders want to do. If you look at this model, and if we try to simplify it as much as possible to have just a model, an essential model with the smallest possible number of the parameters, okay? And we make a change of variable, so we get rid, for example, of this F by operating a change of variable, particularly by fixing xt equal to PT minus the price of equilibrium. And we do the same for PT minus 1. Instead of having PT minus 1, we have YT, which is given by PT minus 1 minus F, in such a way that now we have a mathematical model where the equilibrium, which was given by PT equal to F, PT minus 1 equal to F, will become an equilibrium given by XT equal to 0, YT equal to 0. The other parameters, M of the model, can be fixed without loss of generality equal to 1, and the parameters that can be agglomerated together are agglomerated together, and we end up with this system 11 that you can see is a two-dimensional, because we have xt plus 1 as a function of xt and yt plus 1 as a function of xt. Is a two-dimensional dynamical system which is piecewise linear, because you see if xt is greater than 0, so if the currency of country B is overvalued, we have this type of dynamics. When the currency is at equilibrium, this is the system that regulates the dynamics. When the price is undervalued, we have this system that regulates the dynamics. Now it's important to understand from an economic point of view, for example, what is the effects of the intervention of the central banks. So what are the effects of this parameter B1, B0, A1, and A0? These are also the parameters that introduce the discontinuity in the system, because if we get rid of the central banks, basically the system becomes a two-dimensional smooth dynamical system. Very simple one. And so what we start first, we start with putting B0, A0, A1, and B1 equal to 0. And then we have, as I said, a two-dimensional linear dynamical system, and it has only one equilibrium, 0, 0, which from an economical point of view is what we call the fundamental value. And the stability region, we are left only with two parameters, E, which is the parameter that defines the action of the extrapolators, and the parameter D, which instead put together the action, let's say synthesize the action of chartist, fundamentalist, and international operating firms, so C, F, and I. Of course, when D is positive, it means that C, chartists, overtake fundamentalist and international operating firms. When D is negative, it means that fundamentalist and international operating firms take over chartists. And if we look to the stability region of this fundamental equilibrium in the parameter plane ED, okay, we observe that the stability box of the fundamental equilibrium is this yellow region. Okay. Sorry, here are flipped. E should be here on the horizontal axis, and D should be in the vertical axis. Sorry for this typo. And we observe that as long as D, for example, D is negative, so let's say fundamentalist takes over the action of chartist, we can have stability, as long as, of course, fundamentalists are not too much overreacting to mispricing. Instead, when D is positive, we have this gray region where chartists overtake fundamentalists, and then we have the complete loss of stability. Here we have the parameter E, so the extrapolators, okay? And we can see that as long as the parameter E is between 0 and 1, depending on the value of D, we can have stability. We are inside the yellow region, but of course, if E is too high, higher than 1, then we have the loss of stability. Inside the stability box, the yellow one that we call S, we distinguish 3 different regions, sub-regions. The one that underlined now, which is inside this parabola, sort of parabola. Here we have the eigenvalues of the equilibrium 0, 0, which are complex and conjugate. Instead, here the eigenvalue of the equilibrium, this portion above the parabola, yellow portion above the parabola of the parameter plane, we have eigenvalues that are positive, and here below they are negative. Why I do underline this type of eigenvalues of the fundamental equilibrium? Because they are essential to explain then the dynamics when we switch from 0 to positive, the parameters B1, B0, A1, and A0. Indeed, if we look at the case in which only central bank B intervenes in the market, so the central bank B tried to avoid over-evaluation with its own currency, but the central bank A doesn't intervene in the market, okay? In this case, we have a situation in which when X is positive, XT is positive, the central bank B intervenes in the market and trying to push the value of XT from positive to negative, and therefore there is a in the line X equal to 0, we have a border of discontinuity of our map, and the fundamental equilibrium is exactly on the border of discontinuity. Moreover, due to the intervention of the central bank, we can have an extra equilibrium, which is called PR star, and this equilibrium is along this diagonal, and it can be either real, so when it belongs to the region xt greater than 0, when this branch of the system apply, or it can be virtual when it's in the blue region, so when xt is smaller than 0, when this branch apply. We can also check the eigenvalues and prove that when it's real, it's also a 7. So it can never be both real and stable, this equilibrium. But more interesting is the stability of this equilibrium, the fundamental equilibrium, which stays in this line of discontinuity. And in particular, we can prove, and this cannot be proven through classical eigenvalue analysis, but we need a proof, an ad hoc proofs. For that, we can prove that whenever the eigenvalues of the fundamental equilibrium, in the case in which there was no central bank intervention, so in the case in which the system was linear and smooth, whenever these eigenvalues are complex and conjugate, well, that equilibrium that stays in the border of discontinuity can never be stable. As well, it cannot be stable when the eigenvalues are negative. It remains stable only when the eigenvalues of S are positive. because in that case, they are stable, not in topological sense, but they remain sort of stable in a minimal sense, because in that case, we have the dynamics that, for example, from this region, they go to from the green region, they switch to the blue region, and from the blue region here, slowly they converge to this equilibrium. Okay, so there is, let's say, a right neighborhood of this equilibrium where we have trajectory converging to P, and of course, in the left region, instead, we have a jump from the green to the blue region, where from the blue region, then we converge to the fundamental equilibrium. More interesting, of course, this is the dynamics, the stability of the equilibrium. More interesting about the dynamics of this system is what's going on when this equilibrium, this fundamental equilibrium, loses stabilities. And it's important to underline that whenever the eigenvalues of the fundamental equilibrium are complex and conjugate, we can observe cycles of different periodicity. And in particular, we can analyze the existence region of these, the so-called basic cycles, which are cycles with a symbolic sequence R left to the power of n-1. For example, when we observe the number 2, it means, related to this magenta region, it means that in this magenta region, there is a cycle of symbolic sequence right-left. Here, when we observe 3, there is a cycle of symbolic sequence right-left-left. Right-left means that one point of the cycle is in the green region, right? Oops. And 2 points then are in the left region, so in the blue region. It's interesting to underline that all these, the border of existence of these cycles can be detected analytically. And why it's important to detect analytically the border of the existence of this cycle is because combining or checking these lines of existence of cycles of different periodicity, we can observe that they overlap. So it means that the system generate B-stability. So we can have a cycle of different periods, they coexist and they are both stables. And in particular, we can have, or here we have the conditions for the existence of these basic cycles of period of symbolic sequence right, left to the power of n. These are the analytical expression to derive these curves. They can be explicitated, these curves, only as long as the periodicity of the cycle is relatively low. For example, if it's a period 2, 3, 4, 5, and then when it's 6, for example, it's difficult to explicitate them. But we can already observe that we have, looking at the existence region for cycle of period 2, 3, 4, 5, and 6, we can already observe coexistence. Because we have a region in which cycles overlaps. And to have a look how it is the configuration in case we have several coexisting cycles in our model, we can do some analysis based on basins of attraction, and we can see, for example, for different configuration of the parameters, that we can have interesting dynamics. For example, look at this picture on the left. We have here 5 period cycles of period 5, you see, with this basin of attraction, which is in green. But we also have another stable cycle of period 4 and the period cycle stable as well of period 3. So we have 3 coexisting cycles. A similar dynamics, so coexistence of cycles, can be also observed in the picture, in the configuration represented by the picture on the right. You can see that not only we have coexisting stable attractor, but we also observe that the basin of attraction are intermingled. So we have also complexity given by the fact that it's difficult to predict to which limit cycle will converge because of this intermingled basis of attraction. From a financial point of view, it's also interesting to have coexistence of cycles, okay? Because as I mentioned at the beginning, when we introduce some small noise in the system, actually this small noise allows us to switch from a cycle in which we have a certain type of volatility to a cycle that represents, for example, lower volatility phase. So we have this switch in the volatility phase between high volatility to low volatility that is explained by the coexistence of several attractors, several limit cycles. So in the end, what is the effect of the currency manipulation? So what is the effect of the introduction of the intervention of a central bank in a market without central banks? Is that the effect is just to introduce extra volatility because the stability box of the fundamental equilibrium is broken. We have only a small region in which the fundamental equilibrium remains stable. In the other part of the stability region, instead of having a stable fundamental equilibrium, we have multiple attractors. Is this good for the central bank that do the intervention? Well, it is good in one sense, because if we look, for example, at the configuration of possible limit cycles, we can see that these are limit cycles usually of the form with symbolic sequence, right, left, 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 right. And when it's right, it means that it's bad for the central bank that intervenes in the market, because right means currency overvalued, but left is good. So we have a period in which is overvalued, the currency, but we have several periods in which is undervalued. So for a central bank to intervene is good in the sense that on average, over time, I can decrease my currency, but this comes at the cost of increasing the volatility of the market. Because instead of having a fundamental equilibrium, now I have on average an undervalued currency, but a market which is a bit more volatile. So it's good. If I'm a central bank, I can intervene in the market. I can devalue my currency, but this comes at the cost of a higher volatility in the market. These are some bifurcation diagrams that shows the effect of the intervention of the central bank. You remember that B0 and B1 are the two parameters that defines how strong is the intervention of the central bank. You see, if we increase B0 and B1, so if we increase the strength of the intervention of the central bank, we obtain on average, look at the blue curve, blue line here, we obtain on average a more undervalued currency, which what the central bank wants. But look at the red line, which represents the volatility in the market. You can see that undervalued currency comes at a higher volatility. And it's also interesting, this is also interesting, more interesting from an economic point of view than from a mathematical point of view, it's interesting to observe that it's not in itself the intervention of the central bank that destabilize the market, but is the interplay between the intervention of the central bank and the speculators already present in the market that emphasize the intervention of the central bank. For example, if you look at this time series, okay, with red, here we observe the demand of the central bank. We can see that as soon as the exchange, the price of the currency becomes a bit overvalued, we are around here, it's almost unobservable. The central bank immediately intervenes with negative demand. Okay, you see this red curve that becomes negative. So it means the central bank selling some currency. This produces under-evaluation. Look at the black line. Okay, but this under-evaluation doesn't stop when the central bank stops to do currency manipulation, because the central bank does currency manipulation only for one period, because the period, the next period, the currency manipulation goes to zero. Look at the red line. Okay. But never mind, the currency continues to becomes more devaluated, and this is not because of the action of the central bank, but because of the action of the speculators that capture the signal that the market is going to decrease and the signal is generated by the central bank, they keep selling the currency, and this generates a wave of undervaluation that is more large than what is the wave generated by the central bank itself. So this is interesting to observe how the central bank interacts with speculators to emphasize the effect of its own policy. Here are bifurcation diagram, for example, that also underline that, for example, the effect of an intervention by central banks is amplified when we increase the presence of extrapolators. So if we increase E, which means we increase the presence of extrapolators, we can see that the effect of the central bank devaluation, okay, becomes stronger and stronger. So B, which is the average value of the currency in the market, becomes lower and lower. So the currency is more and more underevaluated on average, although this underevaluation again comes at the cost of a more volatile market. Similar effect here for the parameter D, where when we decrease D, it means we increase the number of speculators in the market, and you can see more speculator in the markets, the effect of an intervention of the central bank of country B becomes stronger and stronger. So the message then that we provide is that, okay, look, if you do currency devaluation, okay, currency manipulation, you can devaluate your own currency, but this comes at the cost of a higher volatility market.
Davide, can I ask you, because you started a little bit late, but we have to stay on time. So can I ask you to conclude in how much time do you think you need?
I think that a couple of minutes I can conclude.
Okay, thank you. Sorry for
it. Thanks, Fabio. So now the question is, of course, one central bank can do devaluation, but if one central bank do devaluation with some currency, of course, this sparks the reaction of the other central bank that can do the same in a speculative way. So if we introduce the undervaluation also of the other central bank, we have a system which is defined as in 15 here in this slide. So we have 3 branches. So we have a map that applies when x is greater than 0, a map that applies when x is lower than 0, and a map that applies when x is equal to 0. Again, we can have a configuration in which we have the fundamental equilibrium that stays in a line of discontinuity, and we can have 2 equilibria outside that are not fundamental equilibrium, and they stays along this line, this diagonal, and of course they can be either real or virtual. They are real when, and in particular, we can find out that if they are real, they are always unstable. So we cannot have equilibrium in which equilibrium different from the fundamental equilibrium that are stable over time. And so what we expect is that when we have a currency war, we will have either convergence to a fundamental equilibrium or some cyclical dynamics, because we cannot have equilibrium outside the fundamental equilibrium different from the fundamental equilibrium that are stable. But if we look at the parameter plane, we observe that actually the stability region of the fundamental equilibrium, which was the yellow region, completely disappears when we have currency war. So when we have the intervention of both central banks, we cannot have anymore a stable fundamental equilibrium. What we are left with, either cyclical dynamics, cycle of period 2 or period 4, and so on and so forth, or eventually we can have something new. We can have a region where we observe chaotic dynamics. This occurs because now we can have 2 equilibrium different from the fundamental equilibrium that are 2 saddles, and this can generate chaotic attractors. We can have several coexisting chaotic attractors with intermingled basins of attraction, or we can have that these 2 chaotic attractors can merge in a unique one, and we can have chaotic dynamics, a single chaotic attractor. chaotic attractors that coexist with divergent dynamics, so the dynamics that diverge to plus minus infinity. Okay, so in conclusion, what is the effect of a currency war? Well, we proved that if this currency war has the same force, is symmetric in the sense that the intervention of one central bank is equal, but the opposite of the intervention of the other bank, well, the only thing that we can have is that either we have limit cycles that are symmetric with respect to the fundamental equilibrium, or if we have limit cycles that are not symmetric with respect to the fundamental equilibrium, then there is also the limit cycle, which is the stable limit cycle, which is symmetric with respect to the fundamental equilibrium to the other limit cycle. They coexist, they are both stable, and also the Bayesian attraction are stable, have the same size, which means that basically if we start with an initial condition that you provide randomly, well, the probability to win the currency war, so actually the expected benefits of a currency war are negative. So whenever the central banks intervene in the market to try to devaluate their own currency, the only effect that they can generate in the long run is an increase of the volatility of the market, nothing more. So in general, this intervention of the central bank's intervention made in these directions can only increase volatility, that from a dynamical point of view means limit cycle, coexistence of limit cycles, or chaotic dynamics, and loss of stability of the fundamental equilibrium, nothing more. So this is the economic message that comes out from this specific model. I think that I can stop here. I went a bit longer. I took a bit more time than what I had. So
yeah, no problem, and thank you again. And participants are still online, so they were rather they keep attention to your talk. So if there is maybe a quick question directly to Davide's talk, anyone, please go ahead, open your microphone, go ahead. Otherwise, we postpone a discussion after Noemi's talk.
No, just a short question for Davide. If you have, you may have also a region with no bank intervention, which leads to a map with 3 regions. Is it right?
Sure, Laura. We can also say that the intervention, for example, of the central banks occurs only if the currency becomes not immediately as it becomes undervalued, but we wait that it becomes very undervalued. Okay, so we wait a bit, and in that particular case, we will have not 2 regions, okay, but we will have a system with 3 different regions, and the border of these 3 different regions are borders of discontinuity.
Okay, thank you.
You're welcome.
Okay, then let's proceed with Naomi's talk. Naomi, thank you for your time, for being here, connected, and so please, the floor is yours. Please open your microphone because we cannot hear you. Maybe I can do it. No. Yes, I open.
So do you hear me now?
Yes. Yes.
Is it working? Okay.
Yes. Please go ahead.
Okay. I'm also very grateful for this invitation, and thanks to Laura for suggesting us. And it's my pleasure to present another example of how nonlinear dynamical systems can be used to explain the dynamics of financial markets. So in the last couple of years, models involving heterogeneous interacting agents have improved our understanding of how financial markets function. And there are several similar contributions that demonstrate that the interplay between speculators relying on the technical or on fundamental trading rules may cause complex boom-bust dynamics and volatile price dynamics. And from the very beginning, one of the key goals of this line of research has been to find a model that endogenously explains the dynamics of financial markets. And a particular hard challenge for such a model is to produce serially uncorrelated price changes. Besides serially uncorrelated price changes, there are of course other stylized facts or statistical properties, such as excess volatility, fair tail return distributions, volatility clustering, and that need to be explained, which is why this research area aims to develop a model that is able to replicate a whole battery of statistical properties. So how has this challenge been addressed so far? So on the one side, we have large-scale agent-based models, and there are some which are able to replicate the statistical properties of financial markets quite well, but they're rather complex, which makes it hard to understand what is acting within them. On the other side, we have small-scale agent-based models that are rather simple, which makes it possible to understand what is going on. But mostly, however, they rely heavily on exogenous noise, which prevents a true explanation or endogenous explanation for the functioning of financial markets. So the goal is to develop a general, analytically tractable and empirically motivated model that is able to match the stylized facts of financial markets without relying on exogenous noise. And we have tried to develop such a model, which I'm going to present now. And the work I'm going to present is joint work with Frank Wissow, who is also at the University of Bamberg. Okay, I will start by giving a short overview of the model's basic structure. So we consider a financial market that is populated by boundly rational speculators and a market maker who adjusts prices according to speculators' excess demand. And speculators can choose between three trading rules, namely a trend following, a contrarian, and a fundamental trading rule to determine the orders. And we assume that speculators display a boundly rational learning behavior and switch between the three rules with respect to past and current performance indicators. So in particular, we assume they prefer rules that have been more profitable in the past. They consider the market's price trends, and if the market shows misalignments. And we assume that this rule selection behavior has a probabilistic nature, in which represents the only type of randomness in our model. So I will get to the details, and I will start with the behavior of the market maker. The market maker adjusts the price, the log price, P, at time t, according to speculators' excess demand, which is denoted by E, by using a log linear price adjustment rule described in equation 1, and A represents a positive price adjustment parameter. So if the market maker increases the price, if the excess demand is positive, and he decreases the price, or she, if the excess demand is negative. DTC, DTR, and DTF denote the orders generated by the trend following, the contrarian, and the fundamental trading rule at time t. And WTC, WTR, and WTF represent their respective market shares. So we are able to express the weighted aggregate excess demand by equation 2. Okay, within our model, speculators can choose between two technical trading rules, where the basic philosophy is to extract trading signals out of past price movements. So the trend following trading rule assumes that the current price trend will continue its direction while the contrarian trading rule is based on the assumption that the current price trend will revert its direction. And we formalize these two trading rules in a rather general way by stating that the orders generated by the trend following and by the contrarian rule are a function phi c and phi r of the current price trend, which is denoted here by Vt. Okay, we assume that both functions are strictly increasing, implying that the trend following trading rules produces buying signals if the trend is positive, and the contrarian trading rule produces a buying signal if the trend is negative. And we also assume that these two rules do not produce any signals if there is no price trend, that is when Vt is equal to 0, which is stated here. Fundamental analysis is based on the assumption that prices will revert to their fundamental value and suggests to buy when the market is undervalued. And to capture this trading philosophy, we formalize this trading rule as a function phi f of the market's current mispricing. And the market's current mispricing is defined as the price deviation from the fundamental value f. We also assume that this function is strictly increasing, implying that fundamentalists trade more aggressively when the market's mispricing increases. And we assume that this trading strategy does not produce any trading signal when prices reflect the fundamental values. And we set the fundamental value f at a constant rate to prevent any exogenous noise to enter our model. Okay, then I get to the fitness functions. Here we assume that their switching behavior depends on past and current performance indicators. We assume that they prefer rules that have been more profitable in the past. They prefer fundamental trading rules when the market shows major misalignments. And we assume that they go for technical trading rules when we have stronger price trends. And to capture these aspects, we formalize the fitness functions of these three trading rules by equation 6, where we state that is given by a function theta. Theta depends on the rule's past profits, which is denoted by gt, and the misalignment term mt, and the current price trend vt. And the probabilities that a speculator will follow the trend following, the contrarian, and the fundamental trading rule are given by the discrete choice probabilities, which we describe in equation 7, where h represents the intensity of choice. And the intensity of choice measures how strongly speculators react to fitness differences. So here we can have two extreme scenarios. Suppose h is equal to 0. Speculators are not able to see any fitness differences. So a speculator will randomly pick one of the three trading strategies. And in the other extreme case, that is if h approaches infinity, fitness differences can perfectly be observed, and all speculators would choose the trading strategy with the highest fitness. So the greater the intensity of choice, the greater the probability that agents choose the trading strategy with a higher fitness. So in total, we assume that we have n speculators, and assume that the number of trend followers, contrarians, and fundamentalists is trinomially distributed, which we describe in equation 8. And finally, equation 9 defines the market shares of the three groups, which is given by the number of each group divided by the total number. Okay, first, we assume that we have an infinite number of speculators, by which we obtain a number of analytical results. So if n approaches infinity, the model's intrinsic randomness vanishes, And the market shares of the three trading rules are given by this expression. And this is due to the fact that the mean of the random variable, WTI, is given by this discrete choice probability, while its standard deviation approaches 0 if n goes to infinity. And the standard deviation is given in the footnote here. And then we have that the evolution of prices is due to a fourth order nonlinear deterministic difference equation. And when we introduce the variables xt, yt, and zt, we can express our model by a four-dimensional nonlinear map. Okay, straightforward computations reveal that our model has a unique steady state at which prices reflect the fundamental value, which is why we denote this unique steady state as the fundamental steady state. So moreover, we define the partial derivatives of functions phi c, phi r, and phi f at the fundamental steady state by b, c, and d. And then we are able, despite our general model framework, to derive the Jacobian, which is given here. And from the Jacobian, we get a fourth degree characteristic polynomial, from which it becomes obvious that 2 out of the 4 eigenvalues are equal to 0, which implies that the fundamental steady state or its stability depends on the eigenvalues of the remaining second degree characteristic polynomial. And then we can apply a set for stability conditions for second degree polynomials and find that the first stability condition is always fulfilled. Therefore, our fundamental steady state is locally asymptotically stable if the second and the third stability condition simultaneously hold. And that is if and only if b minus c is smaller than 3 divided by a and larger than minus 3 divided by a plus d divided by 2. And if the second condition gets violated, while the third holds, we have a flip bifurcation, and when the third condition gets violated, we have an Amaxaka bifurcation. Okay, and to illustrate these results, we set parameter a equal to 1 and illustrate these two stability conditions in this figure. So the inner part of this triangle shows all parameter combinations of d and b minus c, for which our fundamental steady state is locally asymptotically stable. And moreover, we have a cyclical adjustments for parameter combinations that are located in the white area. We have an alternating adjustment for parameter combinations in the light gray area, and the adjustment will be monotonic for combinations in the dark gray area. So our analysis reveals that our fundamental steady state becomes unstable if the trend followers trade increasingly aggressive. That is, if parameter b exceeds the value 3 plus c. In such a situation, we observe the birth of a limit cycle, which implies that the current price trend will tend to continue for some time. The model's steady state can also be destabilized if the quaternions trade increasingly aggressive, that is, if parameter c increases. And then we observe a flip bifurcation in the birth of a period 2 cycle, implying that we have a permanent reversal of the current price trend. And we also have a flip bifurcation when speculators trade increasingly aggressive. Can you still hear me? Okay, perfect. And we also observe a flip bifurcation if speculators react strongly to the trading signals generated by the fundamental trading rule. Okay. To explore the out of equilibrium behavior for a model, we need to specify the orders generated by the three rules as well as the fitness functions. So regarding the orders, we assume that they're generated by a symmetric S-shaped function, and these functions are bounded between the upper and lower limits of the maximum order size speculators are willing to trade, and these are defined here. And regarding the fitness function, we assume that these three components are combined in an additive fashion. So we see the fitness of the three trading strategies depend on the rule's past probability, represented by the first terms. The fitness of the fundamental trading rule increases when we have major misalignments, and the fitness of the two technical trading rules increases if there are price trends. Okay, of course, we know these are very specific specifications, but we have tested alternatives and found that dynamics are very, very similar. We also tested just linear functions, and it also works with linear functions. Okay. Now we are ready to start our numerical analysis, and I will start by showing the main bifurcation routes. So bifurcation parameters for parameters B, C, and D. And the parameters are varied as indicated on the axis. So this panel shows that our steady state becomes unstable due to an Namak-Zaghab bifurcation. At B equal to 4, there we have the birth of a limit cycle, and we see that the amplitude of the cycles increases if B further increases. In the top central panel, we see that our model's steady state becomes destabilized by a flip bifurcation, and we observe the birth of a period 2 cycle at C equal to 3.5. And we also observe a flip bifurcation in the top right panel when parameter D exceeds its critical value. So we conclude that a venture market may become destabilized if speculators rely more strongly on the trend following trading rule, on the contrarian trading rule, or on the fundamental trading rule. And in the bottom row, we repeat these experiments, except that we use higher values for beta, gamma, and delta, which represent the maximum order size speculators are willing to trade. And here we see that the more aggressive speculators are, the higher the amplitude of the dynamics. In the next figure, we show the final dynamics for these 6 panels in the time domain. So first we set B equal to 9, then we set C equal to 9, and then D equal to 9. And here's what we get. So here we see the Namak-Zaghab bifurcation generates a quasi-period motion, implying that the current price trend will continue for some time. So speculators relying on this trading rule will tend to enforce the trend. And here we see that the amplitude of the cycles increases if trend followers trade increasingly aggressive. Here we see a period 2 cycle for the final dynamics of this panel. And in this panel, we see a more complicated price reversal pattern. And here we see, so in the bottom right panel, we see that our model is also able to produce more complicated price dynamics. And this can be explained. So our parameter setting is set such that the price impact of the trend followers and the contrarians are on average balanced. But sometimes there's a mismatch between the price impacts. So depending on the relative size of the market shares, we observe a continuation of the price trend or a reversal of the price trend. So if speculators start to switch erratically between these two trading rules, we may observe a random walk-like price evolution. Okay, now we set the number of speculators to a finite value. And before I show the resulting dynamics, I want to briefly review the stylized facts we want to match. So financial markets can be characterized by bubbles and crashes, excess volatility, fair tail return distributions, serially uncorrelated returns, and volatility clustering. Of course, there are more facts that need to be explained, but these are the facts we wanted to match. And to illustrate these stylized facts, we use a time series of the S&P 500. So here we see the S&P 500, the time over time, so it's time evolution. Here we see the corresponding returns. Here, the log probability density function of normalized returns. And here we plot the autocorrelation function of raw returns and the autocorrelation function of absolute returns. So from the time evolution, we see that the S&P 500 shows significant booms and significant bubbles and crashes. And the corresponding time series of the returns shows that returns varies over time, or the volatility varies over time. There are a number of larger returns. And here we see that here we compare the log probability density function of normalized returns with the one of standard normally distributed returns. And we see that empirical returns, or the returns of the S&P 500, possess more probability mass in the mean, less in the shoulders, and more probability in the tails. Here we see the autocorrelation function of raw returns, and these two lines represent the 95% confidence intervals. So we conclude that most of the coefficients are insignificant, implying that the evolution of the S&P 500 is close to a random walk. Absolute returns show significant correlations for more than 100 lags, implying that we have a persistence in volatility. So the fact that periods with high volatility alternate with periods of low volatility also becomes obvious in this panel. So these are the facts we wanted to match, but before I show our model dynamics, I want to show how we have calibrated our model, or how our calibration strategy was. So first of all, we have not estimated our model, so there is still more flexibility. So I guess there are parameter settings that perform way better than ours. Okay, initially we set parameters A and H equal to 0. These are scaling parameters. We set the fundamental value equal to 0, and we assumed 2,500 speculators. We also introduced the restrictions that the slope parameters of the trend following and the contrarian trading rule is equal. And we also assumed that the maximum trading order size is equal across the 3 trading strategies. So there were 6 parameters left, or 6 degrees of freedom that needed to be specified. And a trial and error exercise decided, or by doing it, we decided to set B and C equal to 2000, D equal to 0.002. And here we have the impact of the fitness components. So E measures the impact of the past profitability, F, I think, misalignment, and G, the price trend. So here we have a combination. We have B minus C is equal to 0, and D is equal to 0.002. So this is a parameter combination that is located within the triangle. So if you would assume that n approaches infinity, the model's dynamics would be locally stable. Okay, now I will show a representative simulation run, which is based on 13,750 observation, which is approximately, or is comparable to a time length of about 55 years. So comparable to the time length we used for the S&P 500. And we see here the evolution of log prices, the corresponding returns, again, the comparison between the log probability density functions of normalized returns and standard normally distributed returns, and the order correlation function of raw and absolute returns. So here we see that our model produces longer periods of overvaluation as well as longer periods of undervaluation. The corresponding return time series show that volatility is high, and we also have larger observations. From the comparison, it gets clear that the distribution of normalized empirically returns deviates from a normal distribution, and we have more probability mass in the tails. From the autocorrelation function of raw returns, we see that our model is able to produce serially uncorrelated returns. So the evolution of log prices will be close to a random walk. And the autocorrelation function of raw returns is very similar to the one we saw for the S&P 500. So we have significant correlations for more than autocorrelations for more than 100 lags, implying we have volatility clustering. Okay, to test if our results are robust, we introduced summary statistics to measure the stylized facts we wanted to match. So to measure the volatility, we computed the average absolute return. To compute or to measure the fat tail property, we computed the hill tail index at the 5% level. To measure the random walk behavior, we compute autocorrelation coefficients of raw returns for lags 1, 2, and 3. And to measure the volatility clustering phenomenon, we computed several lags for the autocorrelation coefficient of absolute returns. And then we perform a Monte Carlo study and report the median together with the lower and upper boundaries of the 90% confidence interval of these 12 summary statistics in this table. And then we compared our Monte Carlo results with our empirical data and found that our model is able to systematically replicate the stylized facts of stock markets. Okay, to explain how our model functions, I use a snapshot of the dynamics. Here we see again the evolution of prices. Here the corresponding return time series. And here we see the evolution of the market shares of trend followers in black. Fundamentalists are white and contrarians are represented by this gray area. So between periods 150 and 250, we have a significant boom-bust cycle, which is associated with a period of a higher volatility and the dominance of technical traders. So technical traders are contrarians and trend followers. So obviously we have that if the market is dominated by technical traders, the price quickly drives away from the fundamental value, while if the market is dominated by fundamentalists, we observe that the price will slowly revert towards the fundamental value. And of course, since we have a constant fundamental value, we also have excess volatility. But the most striking property of model is that it is able to produce serially uncorrelated returns without relying on exogenous noise. And this can be explained by using our results, our analytical results. So on balance or on average, we have our parameter setting is set such that the impact of trend followers and the contrarians is balanced on average. But sometimes there's a mismatch. And when trend followers dominate the market, they tend to continue or tend to enforce the current price trend. It comes to a continuation of the price trend. And when contrarians dominate the market, we observe that the price trend will revert its direction. And since we have this erratic switching between these two rules, we have this random walk-like price evolution. And always when there is a larger mismatch, the market maker needs to adjust prices more strongly, and then we have this larger returns. Okay, so since our model is able to replicate 5 important stylized facts of stock markets, we may conclude that it is validated, or one can regard it as validated. However, we have the fact that our model is or rests on similar building blocks as many other models. So the following question arises: why is our model able to replicate these stylized facts without relying on exogenous noise? And the answer to this question has 2 parts. First of all, our model takes greater account of the trading behavior of contrarians. So we have these 2 regimes in one regime. So when trend followers dominate the market, the Nymark-Sager bifurcation becomes more relevant, and we observe this continuation of a price trend. And in the other regime, when contrarians dominate the market, we have the fact that a flip bifurcation becomes possible, and we might observe reverse of the price trend. So even in a fully deterministic environment, our model is able to produce complicated price dynamics. But the full power of our model is revealed when the speculator's probabilistic rule selection behavior kicks in. So if we set the number of speculators to a finite value, then we have even more erratic switching between the contrarian and the fundamental trading rule, which causes a random walk-like price evolution. Thank you. That's it.
Thank you. Thank you, Noemi. Thank you, Davide, for this wonderful talk. And I have also appreciated the strong interaction between, so it's really like a single talk by two speakers. So thank you a lot. So do we have questions from the audience? You can either raise the hand virtually and you can open your micro, or write in the chat your question.
May I ask something to Noemi?
Sure. Laura, please.
Noemi, in
Yes.
in the cases that you have considered with the numbers in figure 6, there is a symmetry with respect to contrarians and the other fig 6, the last fig 6.
Wait a second. Figure 6, yes.
Yes,
Yeah.
exactly. The last one. This symmetry is probably due to the particular case of the parameters that you have used in this simulation.
Yes. Yeah.
Yes, because there is just a symmetry here between the blacks or trend followers and the contrarians. Yes, so the symmetry is due to this. Have you tried also a case without this symmetry?
Yes. If we, like for instance, if the impact of the trend followers is stronger,
yes,
then our model would produce a positive serial correlation.
Mm-hmm.
And if contrarians are stronger, our model would produce
so it is
a negative serial correlation. So it's important that the impact is balanced. Yeah, that's important. Yeah.
Thank you, Noemi. Thank you.
Okay, thank you. Are there other questions for Noemi or Davide or both? I don't see raised hands. Let me look here. Okay. No question from the chat. So let's wait for a couple of seconds if someone would raise a question. Okay, so if not, maybe we should conclude this seminar and in general the whole series of talks. As a small sign of our appreciation, we usually give the free membership to our speakers. So this is the case for you, Noemi, and for you, Davide. So you will have this 4-year membership to the Italian Society of Chaos and Complexity. And it's a small sign to say thank you, to have accepted this invitation and done this interesting talk. So I think that's all for this year. I want to thank the speaker of today's lecture, but also the previous speakers and all the participants of this event. And possibly the last year, we will go back to the previous formula, which was in presence, a series of seminars concentrated in a couple of days, where possibly we will have more interaction among speakers and participants. And that's our hope for the near future. Okay, thank you. Thank you all of you.
Do we have to send you the slides? You want to collect them or?
No, that's fine because we have the videos. So interested people can have a look at the videos and that's fine. So thank you, David, in any case for
Thanks.
Kind of. Okay, so let's close this session and say goodbye to everyone. Bye. Ciao.
Bye. Bye.
Ciao Davide.
Ciao.
Ciao Noemi.
Ciao.
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 Ciao, chiudo la sessione allora.
Ciao Mattia.
Ciao.